My name is Helio Brindero. I'm Managing Director of Navigate and Advisor. I'm here with David Bassanisi. We're here to have some questions that we've been sending throughout the year. We're going to discuss quarter. So thanks, Dave, to be here with us today.
Great to be with you.
So, Dave, one of the questions here we've got from you is, we understand the committee made a decision to remain neutral between growth and defensive assets. What led to that change? What was the rationale behind it?
Yeah, so this is a position we've actually had for a few quarters now. Really, at the moment, there's a push-pull going on in global markets. The negative is the ongoing war in Iran. We're hopeful that war will end and oil prices will come down and we can avoid a global recession. But, as we speak today, there's still unresolved. And so that's just a major negative that potentially could have a bad outcome for equity markets. So that gives us some pause at the moment. We're not underweight equities though, because offsetting that is the ongoing AI boom. So the global markets are looking through the Iran war, hopeful for deal, but also very optimistic around the ongoing corporate boom associated with AI. Corporate profits are booming, demand for technology products is booming, and equity markets are continuing to grind high. So net, we think it's warranted to be neutral at this position, and we'll just see how the war plays out, when and if it does end, or if we think it will end. But when it does convincingly end, might be a time to put a bit more risk back on the table. But at the moment, we're happy to be at a neutral position.
Okay, I'm glad you touched Iran, because we want to go there a little bit further. So let's go there. You mentioned Iran. What's going on every day, every news?
Yeah. Look, I mean, the reality is that I think Donald Trump wants to end the war. He wants to extricate himself from the situation. But the Iranians are playing a very hard game here. They have the Strait of Hormuz under control. Donald Trump can, I guess, lob bombs into Iran, but it doesn't seem to shake the regime at the moment. So he's trying to strike a deal, but every time he kind of gets closer to one, Iran's pushing back. Now, just recently, they did announce a big deal, and it seemed that Iran got a lot of the things. It actually wasn't expected to do a lot to end the war, but even that has now, I guess, has broken apart because of Israel's ongoing bombing of Lebanon, and Donald Trump can't resist threatening more bombs. So it's still shaky, but look, what guides us ultimately is, what the term that was used last year, the taco trade. Ultimately, if push comes to shove, I don't think Donald Trump is going to risk a lot higher oil prices, which could cause a US recession, and he will strike a deal, even if it's a pretty weak deal, just to get himself out of Iran. But that's the situation at the moment, to our minds. It's been remarkable, though, having said that, oil prices have not gone up to $150, $200 a barrel, despite 20% of the global oil supply being taken off the market, because there's been massive rundowns of available inventories around the world. So at the moment, global markets are eating into their inventories, but there's a time limit to how long you continue to do that. So that's the pressure that is constantly being brought to bear of Donald Trump, ultimately, So we'll see, as I said, push comes to shove, but at least the saving grace in the short run has been that oil prices have not gone a lot higher.
Okay, thank you. So we mentioned about equities a little bit. So obviously we kept overweight in hedged global equities while moving underweight in Australian equities. Just explain a little bit that positioning.
Yeah, so a couple of developments we think over the last few months. Firstly, the prior period we were still neutral equities, but we were underweight US equities, overweight non-US equities. A very small tilt within the portfolios, and that was due to concerns around AI disruption and the idea that the companies are spending too much on AI. Software companies are going to get disrupted as businesses in-house a lot of the programming. Now, it turns out the AI concerns have dissipated somewhat. AI has come back quite nicely over the last few months. At the same time, we've had the May budget in Australia, which has cast a pall over the Australian equity market and the economy. It's going to hurt property prices. It's hurting business sentiment due to the increase in capital gains tax, not just on residential property, but on all assets. And so that makes us more, I guess, negative about the Australian outlook, whereas the outlook for the US market of technology has improved. So net, what has that meant is that we've still kept a neutral outlook due to the fact that the war has not gone away. But we've now have an underweight to Australian equities instead of an underweight to US equities relative to the broader global equity market.
That makes sense. Thank you. Other question we have is, you have maintained a preference for hedged rather than unhedged global equities. Just take us through that. What?
Yeah, so this is, I guess this is an ongoing view that the US dollar ultimately we think is still very high in real terms. Prior to the war, it was on a declining trend, and we think that will continue post the war. The US dollar weakening, central banks looking to diversify away from the US dollar. Now, I think just in the short run, due to the war, that's been disrupted somewhat. But I guess that's one bet where we are keeping it in place in the expectation that the war will eventually end and the US dollar will resume its decline and the Aussie dollar will resume its ascent. Underpinned by, we think, ultimately a more hawkish outlook for the Reserve Bank. We don't think the RBA is likely to raise rates anymore, but we think the risk is that they're more likely to raise rates, we think, than, say, the US Federal Reserve. And so that will keep upward pressure on the Aussie dollar once this Iran war
Is that what would you
dissipates.
look at to revisit? Is that would be one of the reasons the RBA catch ready would do revisit that strategy? What would you make you revisit that strategy of hedging or not hedging?
Look, if say, for example, the war got a lot worse, we went into a global recession, for example, we think that's would be a negative for the US, for the Aussie dollar, and the safe haven attributes of the US dollar will actually probably come to the fore. So if we were a lot more negative of the global economy, we would be less inclined to be hedged and fear the Aussie dollar would sink. But yes, that's not our base case, but that would be
the case.
That would be, if we thought the US dollar safe haven trade would come back to the fore in a major way.
Right. Well, that's clear. Thank you. The other question here, we hear a lot from clients, gold. Everyone loves gold. So we were overweight in gold. Now we retained the overweight in Australian bonds. But so explain to us how do we remove this overweighting in gold?
So firstly, we've been overweight gold for a couple of years now to really help the portfolio performance. And the central thesis for that was Reserve Banks, again, diversifying away from US Treasuries, US dollar, buying up gold as in their portfolios. Certainly post Russia's invasion of Ukraine and the fact that the US Treasury was able to take freeze a lot of Russian assets. So central banks looked at that and said, we need to not be so reliant on US assets. With the war in Iran, you would have thought that would add to the upward pressure on gold because of inflationary concerns. Usually that supports gold. It hasn't supported gold. Probably been a little bit disappointed with gold's performance during the aftermath of the Iran war. A couple of reasons. We think gold, markets got quite long gold. And so it was one of the first things that was sold to raise cash with the uncertainty of the war. And also the increase in US, basically inflationary concerns in the US due to the lift in oil prices, perversely didn't help gold, it hurt gold because it put upward pressure on US bond yields. So we think at the moment gold is trading in line with risks around the Iran war. If the Iran war gets a lot worse, gold will probably get worse. But if the Iran war ends quickly, gold may actually start to come back into popularity and the US dollar will weaken. But at the moment, we've got a lot of positioning on the war ending and that we are not underweight equities. We're still fully invested in equities. We've got a position in hedged global equities on the view the US dollar will eventually strengthen. And we just think that extra position in gold is probably one extra too many for the moment that we need, given the way it's been trading. So we thought take it off the table, see how the war plays out, and then revisit that position a bit later.
Yeah. What about Australian bonds? Because we retain overweight there compared to anywhere in the world.
Yeah, well, it's really overweight compared to cash, and really comes back down to, again, at the end of the May, when the models were reviewed, the markets had 1 to 2 more rate rises expected by the RBA this year. We thought that was overdone. We thought the RBA had done raising rates. We thought the last rate rise was in early May. So we thought the markets were too pessimistic on rate rises, and hence bond yields probably higher than they will be by year end. So we thought bonds were think bonds are good value relative to cash. And so again, bonds are going to outperform cash provided bond yields don't rise too far. If they go sideways to down, you get a capital benefit from bonds, and then you get the yield pickup from bonds relative to cash as well. So ultimately, the more aggressive outlook for interest rates in Australia that the market had priced in was the reason to prefer bonds relative to cash.
Right. And what do you think about the cash rate? Are we going to look another hike? What's?
Yeah, I mean, just on that, I mean, we do have the RBA on hold now. I mean, there was, again, even before the war, we thought that there would be one more rate hike in May and then they would be done. That would be enough to slow the economy and help bring down underlying inflation. It would unwind all of the rate cuts that we got in 25. Now, the federal budget's come along, and we think that's now going to do some of the work of the RBA. To the extent the RBA was thinking about raising rates further, I guess the negative hit to confidence from the budget and the negative hit to the property market is doing some of the RBA's work. So we're even more inclined to think the RBA is done raising rates. Yeah, so we have the RBA on hold, and at this stage, the next move probably down, but don't hold your breath. It's probably second half of 27 rather than anytime soon.
Because I guess we're just waiting to see what happens with the inflation.
See what happens with inflation, with the war, with the budget. I mean, again, the government seems to be digging in its heels with regard to the capital gains tax changes.
Yeah.
And so, we think that's and it's going to be an extra negative for the Australian economy, unfortunately, for the foreseeable future.
Yeah. And there's one more question they want to ask you that's not in here. It's about SpaceX.
Oh yes.
Yeah. So what's there? What's the unusual there? Biggest IPO ever. I've read this morning that there was 4 times more IPO invested from Australians than any other IPO ever.
Yes.
From a US company, and
Yes.
then they managed to increase 40% up. Last time I checked, after the IPO. So what's?
Well, again, it's AI euphoria at the moment. I mean, there's a lot of debate is SpaceX fairly valued or not. I mean, a lot of the value comes from the AI part of the business. I won't get into it too much, but the rockets that everyone's excited about, if you look at the profit and loss, actually doesn't expected to generate a lot of the profit. It's more the AI side, but that may come down the track. But look, to us, it demonstrates that we're still in the early to mid stages of the AI cycle. Now that may eventually end up becoming a bubble and again a massive blow off, but we think we're still at the relatively early stages of that. There's more IPOs to come. We've got ChatGPT and Anthropic to come. And we know, demand for AI services is still running ahead of available supply. And we think we're sort of early to midway through what is at the moment a quite a positive development for markets.
So this was our last questions. I appreciate Dave for your time, and I appreciate Betashares for having us here. Thank you all.